time to talk money, all things stock market related now. And Philip Scott from Simple Investments, based in Godalming, joins me. Morning, Phil.
Hi, James. Morning.
Now, we want to talk a bit about interest rates, which some people completely zone out and yawn at the mere thought of it. But there's been lots of discussion and the direction of the UK interest rates in the forthcoming years. But it will affect absolutely everything, won't it?
It will indeed, and I think it's hugely topical right now. And of course, if we talk generally about interest rates, and I know what you mean, that some people probably don't focus on this type of thing too much, but the implications of an interest rate rise are far-reaching, not just for people with savings accounts, for obvious reasons, getting a better return on their money potentially, but most importantly for businesses that carry large amounts of debt. An interest rate rise would materially affect the operational side of a business. And in terms of the stock market, which of course is where I'm at day to day, interest rate rises, well, again, people are nervous about the impact of such a thing on corporate profitability and ultimately where a share price may go. So it's interesting right now because Mark Carney, the current governor of the Bank of England, has recently indicated that interest rates shouldn't need to rise before 2016, which is obviously 3 years away. Unless unemployment reaches, say, 7%, then he may think again. But the interesting thing is that we're seeing some very encouraging, albeit only in the recent past, UK data in terms of manufacturing, services, construction, all these arenas doing much better. And the city seems to have decided there's an interest rate rise coming probably at some time in the next 12 months. So Mr. Carney, just recently into the new job, is potentially in quite an embarrassing situation if he's going to have to backtrack on what he said so far.
So why would he increase it if that could actually affect companies' profitability, and if their profitability is affected, that would affect their share price?
Well, exactly. But I mean, his argument would be there's still considerable slack in the UK economy. There's a lot of structural imbalance still. It could be that the data that we've seen just recently will be short-lived, and we're having some kind of seasonal bounce, which will reduce as we move through the autumn. But I think his view is that we shouldn't be getting too carried away, because he actually feels that companies are probably still struggling somewhat, despite this macroeconomic data that I've been talking about. So the indications from some of the data is that UK is doing better. But I think he would argue, be careful, there's still a lot of work to do. So he would be very nervous about increasing an interest rate because it would stifle off any economic recovery we're seeing.
Well, for anyone who's got a mortgage, it's sort of their knees start to knock at the thought of the actual payments going up. But I suppose for anyone with savings, a lot of people who are retired are probably sitting there just looking at their money really going nowhere. It's just sort of almost decreasing in value, isn't it?
That's very true. And obviously inflation being what it is, let's say inflation's running at the target for the Bank of England is 2% inflation and no more. As for how inflation is calculated, well, I think we should look at that quite carefully. But I think all of us know that water bills and energy bills and other things in our lives tend to go up quite materially year on year. So when I hear that inflation's only up to running at 2% per annum, well, I'm guessing that many of our outgoing bills have gone up by more than that. But you're right, a low interest rate on savings means you're not keeping in line with inflation. So effectively, your money lying dormant in a bank account, safe as it is in the bank account, on a miserly interest rate of, say, 0.5% or maybe 1% if you've done a bit of homework, well, you're still not keeping pace with inflation. So you're actually, in real terms, losing money in your savings account relative to your bill. So absolutely, an interest rate rise would be good news for savers, but the risk is that it's punitive for, say, businesses, and it could stifle off any early stage economic recovery we're seeing. So this is what he's having to juggle. But as I said earlier in the call, his reputation is potentially a little bit at risk here, only 2 months into the job.
So him getting a red face might actually keep the interest rate down then.
Well, exactly right. So we'll see where he goes. But he's speaking later in the week, and he's hell bent on his view. It's telling us that the interest rates will not be rising. Maybe he knows something more than we do, but certainly the boys in the city, the way they're pricing certain shares and bonds, they are convinced that we see a 0.5% interest rate rise within the year. So we'll have to see.
All right, good talking to you. Thank you. Philip Scott from Simple Investments, based in Godalming.